I've discovered that people enjoy making investing very complicated. Contrary to popular belief, investing is incredibly simple and highly rewarding if you just master a few basic principles. Without exaggeration, the strategy I'm about to outline performs 99% of all actively managed assets. And in contrast to every other chance available, the less labor you put in, the more money you make. You may learn everything you need to know about money making in the markets using the best index funds available today by watching the video to the very end if this sounds completely impossible or too good to be true. Now, before we discuss my top 5 favorite index funds, here is all you need to know in the next 60 seconds if you're wondering how this works or why it's so successful. In order to hold a little percentage of everything, you could purchase into an index fund, which is essentially just a large basket of companies for a single low price. For instance, it would probably take you a few hours and cost you almost $92,000 if you went out and purchased each and every individual stock in the S&P 500. In order to simplify investment and track the entire market, an index fund was developed. Warren Buffett even claimed that the best stock investment is a low-cost index fund. Over a 20-year period, investment in index funds has outperformed even the best professionals for the vast majority of investors. Statistically, you'll profit more from this than from any other stock market investment you can think of. Additionally, this strategy involves less effort because there is no need to study stocks or review earnings reports. You'll get a lot of diversity and all you need to do is click a few buttons occasionally to finish. It really is that simple. There are index funds covering just about anything you can imagine, including the S&P 500, real estate, tech stocks, small and mid-sized businesses, huge international real estate, developing markets, dividend sustainability, and even cloud computing. Therefore, regardless of who you are or what you want to invest in, an index fund probably has you covered. Finally, the largest benefit of them all is that these index funds are low cost to manage, and since there isn't much overhead, the extra cost is passed on to you, the consumer. So with all that financial lingo out of the way, here are my top 6 index fund investments that you might make right now. I'll explain why I like them, how much they cost, what each one offers, as well as what you might earn over the next 10 to 20 years if you invest in them. The traditional Vanguard S&P 500 Index Fund, VFIAX, currently came first. Since Vanguard is the largest and was the first to develop the index fund back in 1975, we're going to concentrate on them since their index funds pretty much cover everything that we're about to mention. Just to be clear, almost every brokerage out there has their own version of the S&P 500 Index Fund, like Fidelity has Fixed Physics, and Charles Schwab has Sweptics. In this instance, VTIAX was developed to follow the whole S&P 500, which includes the top 500 U.S. publicly traded stocks. Investing in the single fund is essentially the same as purchasing the corporations that account for 3/4 of the value of the whole stock market. The advantage is that investing in the S&P 500 exposes you to the larger companies, which often have a longer track record and are therefore more stable. Additionally, you're betting on the long-term expansion of the U.S. economy, which history has repeatedly demonstrated to be both incredibly robust and extremely successful. All the household names like Apple, Microsoft, Amazon, Tesla, Google, Nvidia, and Netflix are among their top holdings. Since its debut in 2000, it has annualized the 7.9 return, which is why it is now all the way on page 2. 10 years ago, a $10,000 investment would be worth $35,000 today. You might be thinking, but what's the catch? This sounds too good to be true, because there's always a catch. You should be aware of a few minor drawbacks. First, there is a $3,000 minimum investment required to purchase into the funds. Second, there is a 0.04 yearly management cost, which is 0.01 cents more than their ETF equivalent VU. If that sounds unclear, allow me to explain. In general, there are two different strategies to track the market. One uses an ETF, the other an index fund. You might set up an automatic repeating investment with an index fund so that you could consistently dollar cost average into the markets. At the end of each trading day, you could buy in with a precise dollar amount down to the last cent, but that would require a slightly larger minimum investment with money that is typically not transferable from one brokerage to another without paying a substantial commission. In contrast, there are no minimums for ETF trades like stocks as long as you can afford the share price, and you can transfer your holdings between brokerages if you choose to change businesses. In contrast to index funds, you cannot set up automatic recurring investments, and occasionally during times of high volatility, the fund may trade for more than the stock prices, meaning that when you trade an exchange-traded fund, you are trading the basket of stocks rather than the individual stocks themselves. As long as you know what you're investing in consistently, either choice will be good for most people. However, as good as something like the S&P 500 is, it still leaves out a significant portion of the market. With index funds, you purchase the actual underlying shares. Within the fund, there is a very small difference. This brings us to the second total stock market index fund, VTSAX. Let me know in the comments if you have any other questions about investing. Let's return to the video. Now, as opposed to our earlier example, which only contains the S&P 500, VTSAX is created to provide you exposure to the entire US equity market, including small, mid-size, and large-cap stocks. For a single cheap price, you may own a small stake in as many as 4,100 different stocks. Additionally, since it began more than 20 years ago, it has returned an average of 8.2% yearly, making a $10,000 investment worth $34,000 now. If you think the US will continue to grow, the benefit of a total stock market index fund like this is that it's so thorough and diversified across the country that it might essentially be the only investment you make going forward. Of course, if you're wondering how this fund generates higher income than the S&P 500, because this one generates 8.2%, while the other one generates 7.8%, what's going on there? And because there is so much market variety, these are excellent questions that I ask myself. When you include the smaller equities in your portfolio, which are more likely to see larger gains, it starts to make sense why this fund has a little higher profit. As evidence of this, between 1980 and 2015, smaller stocks had average annual returns of 11.2%, whereas huge stocks generated average annual returns of 8%. Consequently, it would be a good idea to broaden your investment base and increase your level of diversification. Naturally, VTSAX requires a $3,000 minimum deposit and charges a 0.04 yearly administration fee, just like in our previous example. The bad news is that this only covers the United States. And as we all know, the world is a very large place. So as a way to bridge that gap, we have number 3, the Vanguard International Index Fund, VTIAX. Although you can choose the ETF version VTI, and that gets you all the diversification you would need without that pesky minimum investment, the good news here is that this only encapsulates the United States. This index fund invests in stocks in developing countries, like North America, Europe, the Pacific, the Middle East, and other international markets. The companies we use every day, such as Semiconductors, video games, Alibaba, Samsung, Nestle, Toyota, and others, make up some of their greatest assets. The benefit of this is that as other nations prosper and grow, their stock prices rise, and as a result, your money grows even more. However, over the past 10 years, international stocks have been relatively flat, while over the past 20 years, the US stock market has been on a tear, outperforming just about every other market worldwide. There have been numerous occasions in history when foreign equities have outperformed American stocks, such as for much of the 1980s and 2000s. While this is not a given, there is undoubtedly a potential that it will happen again. Since its founding in November 2000, an investment like VTX has returned around 5% yearly, and it will give you a dividend of about $3.37 every year. That means you'll receive $337 in lovely passive income each year for every $10,000 you invest. Although like the other examples, Vanguard does have the customary $3,000 minimum and charges a higher expense ratio of 1% because international stocks are more difficult to execute. There's also the ETF version VFIAX US with a slightly lower 0.7% expense ratio. And even if it underperforms in comparison to the US, at least you're getting paid a slightly higher dividend in the interim. VTIAX is the fourth item. Even though it may initially seem to be very similar to the S&P 500, you'll soon discover that this fund is all about finding the fastest growing businesses that will maximize your profit. To put it another way, if you took the S&P 500 and eliminated everything that doesn't have high growth potential, you would be left with this. The 266 various firms that make up VTIAX are all focused on the industries that have recently performed exceptionally well, and this fund has an annualized return of 8.6 since 2001. Although the $3,000 minimum and the 0.05 expense fee for managing the fund shouldn't come as a surprise at this point, you may alternatively choose the comparable ETF bug, which has a slightly lower expense ratio of 0.04 and can be yours for just $250. Even if, in retrospect, you would have made a lot of money with this fund over the past 20 years, the situation might change during the course of the next 10 years. The adage, previous outcomes don't guarantee future performance, is true in this case. Growth stocks like these performed the poorest from 1997 through 2013, out of just about every category. And if we go all the way back to 1992, VTSAX was frequently the undisputed winner. All of this is to say that even though this can be very profitable, if things continue on their current course, it's probably best to throw everything into a more diversified approach, which would be 5, the Global Stock Market Index VTIAX. If you build a portfolio based on the previous 10 years, you might not see the same returns as we have in the future. In other words, if you took what I just described and crushed it, that would be this when put all together, added to emerging markets, and sprinkled on just about everything you could think of. With a portfolio of more than 10,000 different stocks, it provides you with exposure to the whole global stock market. Therefore, this is about as varied as you can go without taking into account that Lego set investment you've been eyeing on eBay. While you also receive exposure to some of the biggest international firms at the same time, their top holdings include things like our US-based corporations. Even though this fund was only established in 2018, it generated returns of slightly over 6% over the previous year. Over the past 3 years, it has consistently been above 13%. The disadvantage, as usual, is that there is the same $3,000 minimum investment and a 1% management charge, making it one of the most expensive alternatives on the list. However, their ETF equivalent VT costs just 0.07% and offers nearly the same investing opportunity. Personally, I think this is a fantastic option if you want to experience everything without skipping a beat. Most likely, this is the right choice for you. Of course, if the United States continues to outperform and offer these disproportionate returns, which is very possible, you might be leaving money on the table. Finally, I thought it would be amusing to add one more to the list, and that would be the Vanguard Real Estate Index Fund, VIG SLIX. This one works if you want to take a more diversified strategy. In this index fund, which invests in a variety of rates, you don't own a portion of a stock. Instead, you own a portion of a business that owns and manages both residential and commercial real estate. It's essentially the same as owning a very small percentage of the hospitals, clinics, hotels, shops, warehouses, and everything else for just $147 per share. Additionally, a 2.9% annual dividend is included. Therefore, regardless of what happens to the stock price, you will still receive a little percentage of your investment back. The bad news is that they do have the highest expenditure ratio, 0.12%. But the good news is that they have the highest returns since 2001, averaging over 10. Of course, when interest rates rise, it's not yet clear how much of an impact they will have on real estate values, so this fund may decline. On the other hand, it may also be a great method to obtain exposure to the real estate market without having to go out and purchase any property directly. And when it comes to my own investments, I diversify across practically everything by using a variety of index funds. Over a 20-year period, if all you did was consistently invest in a well-diversified index fund, you would outperform the vast majority of actively managed funds and place yourself in a strong position to maximize your returns. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.